Hello, fellow Rebel Capitals. Hope you're well. So we've got a lot to talk about today. Ed Dowd, formerly from BlackRock or Blackstone. I should know that. I'll look it up in a second. But one of my favorites, experts, market commentators, is out warning of a deep recession. So we want to really pay attention to what Ed is saying. Really, really smart guy. We're going to get into the details in just a moment. Also, along the lines of recession, a banking expert came on a podcast that I'm a big fan of the other day and was talking about how he sees a downturn in housing. So what I did is, believe it or not, some research. And I looked up what the housing market is as a percentage of GDP. Because we hear Warren Buffett talk about the Buffett indicator all the time. That's basically the market cap of the stock market relative to the US GDP. Well, it's overvalued, undervalued, etc. Well, I wanted to do the same thing for the housing market. That's not to say that it's the same concept that this tells you that the housing market is undervalued or overvalued or whatever. Obviously, I don't know if the same correlation would hold true, although I think there is some overlap there. What I'm more so looking at this through the lens of how important is the U.S. housing market to the U.S. economy. Also here, we've got Michael Saylor coming out with his new company named Strategy, right? Well, they've got a new strategy. They've got a new Bitcoin strategy. And I think it's worth analyzing to the extent to which we can. It gets very convoluted and rather complex. But I think at the very least, regardless of your view on Michael Saylor or what his strategy, no pun intended, is, it's fascinating. Really, really interesting stuff that I think we need to pay attention to, especially if you're concerned or if you're interested in the price of Bitcoin over 2025. Then lastly, market way up today. But I think what's more meaningful is why it's up. And are we going to see more or less of this moving forward? And is this just a counter trend rally, or is this a new bull market where we're going to go back up to all-time highs? All right, so let's get into it, guys. First and foremost, let's go over to Zero Hedge. Let me do a screen share. Josh is MIA. You guys got to give him a hard time in the chat and in the comments. Josh is slacking. All right, so I'll have to do this myself today. And we're going to go over to Zero Hedge. Ed Dowd fears a short but deep recession coming as Doge exposes mind-shocking fraud that propped up Biden's economy. And I think, you know, I really enjoy listening to Ed, and I strongly suggest, if I believe he's on Twitter, but following him wherever he is. And I'm going to give him a shout out here with his website, finance, spelled PH, technologies.com. You got to check that out. So, former Wall Street money manager, and just for my own personal curiosity, where did Ed work? I think BlackRock. There you go. It was either Blackstone or BlackRock. Yeah, BlackRock. Okay. Investigators have uncovered 115 billion so far, with many hundreds of billions more to be exposed. He said both sides are guilty, which I completely agree there. The Doge revelations are mind-shocking. The clear way in which government was spending money through NGOs and people taking kickbacks and profits. Basically, what he's saying is that if this is going away, that's a good thing. But in the short run, it's likely going to impact aggregate demand because it was such a big component of the U.S. economy, as sad as that is. So Ed wrote a paper, which again you can find on his website, and it's this report. He said, we were surprised on how fast Doge would get to work. This is why our thesis is playing out a little quicker than they thought. The housing market was on fragile ground last year, so it was held up by illegal immigrants supporting rent rates. Yeah, I don't know if I'd agree with that too much, but so as that unwinds, we think there will be mini 2008, 2009 housing issue. Housing prices are going to come down. That's a big driver of consumption in the U.S. economy. Now, this obviously I completely agree, and we're going to get into the new Buffett will call it the Gammon housing indicator in a moment. That needs to happen because home affordability is off the charts. Yeah, that's the downside to home prices going up. Everyone thinks that, oh my gosh, we always want asset prices to go up higher, higher, higher. That's if you're a seller or if you own assets, yeah. But if you're trying to buy assets, which is a large portion of the U.S. society, then you want lower prices. You don't want higher prices. We just always tend to look at whether it's bad or good through the lens of the people that already own the assets. So Dowd also sees recession coming as government downsizes. Consumer confidence has taken a nosedive. Absolutely true. There are 10 million to 15 million illegal immigrants worried about the gravy train coming to an end. Yep. Who knows what was going to these people? I always tell the story of when I was spending some time in Nogales on the Mexican side. And just long story short, there was a guy that I knew over there, and he would tell me how he crossed the border like a couple of years ago or something like that, and got like this card. And initially, he went over to get the card illegally, by the way, to get like a $2,000 payment or something like that to people crossing the border for whatever reason, whatever government program was going on at the time. And he said that he was supposed to initially just get like a $2,000 payment, like a $2,000 prepaid debit card or something like that. But he said every single month, the government adds another $400 to it. It's like, this is amazing. I just get a free $400 every single month. And he's not even in the United States. He went back to the Mexico side and he still gets the $400 or whatever it is every single month. So who knows? What's going on? And I think Ed's point is hopefully if they get to the bottom of this, that's a good thing, but that will likely decrease spending quite significantly, maybe more so in Mexico than it will in the United States. Dowd likes gold as a core asset. Makes sense. He says the problems on tariffs are overblown. Yeah, so I don't like the tariffs from an economic standpoint. That's for sure. But I do agree with him that the way the mainstream media is painting it, it is overblown. Look, I think it's a net negative. Do I think it's catastrophic? Like the mainstream media is leading you to believe? Nah, come on. But I guess that depends on to what degree they're implemented. If you told me, hey, he's going to implement a 200% tariff on everything coming into the United States. Okay, now we're talking catastrophic. But he's not even floating that. And I think most of what he's talking about really isn't going to come to fruition because he's more so using it as a negotiating tactic. And in that case, I think it's a good tool. More on that in the last topic of discussion here on this live stream. Dow sees deflation and possibly a short but deep recession coming before inflation. I couldn't agree more. Maybe deflation. I don't know. Definitely disinflation. I would not be surprised if over the next 6 months, year, the official CPI gets below the Fed funds rate, or below the Fed's target rate of 2%. Would it go actually negative? If the central planners step back and just let the free market work, absolutely, I think we'd have deflation. Absolutely. But I just think they really, since Greenspan, they've had more and more of a hair trigger, if I'm using that term correctly, where at the sight of bad news, they're just immediately doing something, right? to the point where during the cerveza sickness, I mean, it's like 2 weeks in and they're bam coming to the rescue. So I don't know. I guess there's two questions. How long would it take them to respond to, let's just say, a recession type event? And then what would be the efficacy of their programs? Because that's something that people always assume that, oh, well, we've got a Fed put. Maybe. I mean, we didn't really have one during the cerveza sickness. To me, that's a misconception of what happened. If you go back and actually look at history, and I know this because I was reporting on it every single day, when the Fed put came to the rescue, the market basically gave them the middle finger. The market kept going down, even after Fed dropped to 0%. And remember when they announced up to like $1 trillion a day in repo and all these things and QE unlimited or QE forever. And the market still went down. The market didn't really rebound until we came out with fiscal. So with Doge and Elon and Trump and everything that's going on, how quickly will the government respond with fiscal? I don't know. It'll take more time than I would assume if Kamala Harris or Joe Biden was in office. But it's just, what are the probabilities, right? I mean, how much pain would Donald Trump be willing to withstand before he steps in and makes an excuse as to why, under these circumstances, and the way he's going to increase the size of government or going to do fiscal spending or fiscal deficit spending is going to be fantastic and great and the best thing that you've ever seen. Whereas if Joe Biden did it, well, he's the worst president in human history. So, you know, the way Trump likes to spin it there. But my point is, the longer they waited to implement the fiscal, I think the higher the probability of deflation if you get a recession. And the more knee-jerk reaction they have to it, then I think I lean more towards disinflation. I do not see an environment where you have a recession, especially a deep recession, that is inflationary, meaning not that we have consumer price increases, but that you have an acceleration of the CPI. So in a recession, obviously we're adjusting for the rate of inflation there. So in real terms, we have a contraction of GDP over 2 consecutive quarters while we have a spike in unemployment as the CPI goes from 2.8 to 3 to 5 to 7. And the reason I don't see that as a high probability is because you go back even to the 1970s, and all the recessions that we had were all disinflationary. None of them were inflationary, where inflation was actually increasing or accelerating. So then he talks about how it would be a plus for the U.S. to stay out of any conflicts. Couldn't agree more there. So now he's talking about a black swan event. This is interesting. I didn't see this before. Another black swan event is a Bank of Japan currency crisis and also something going on with Iran in the Middle East. Black swan events add to the risk, are hard to predict, by definition. Yeah. And then here is his new report that you can find. It's Danger of Deep Worldwide Recession in 2025. And you can find that at finance, spelled PH, technologies.com. And then I guess Ed has a book called Cause Unknown. And then you can find that, I'm sure, on his website. So now let's go over and check out kind of this new indicator. And again, I don't know if I would really use it the same way as you use the Buffett indicator to find out if the market cap of XYZ asset is overvalued or undervalued. Although I think there would be some correlation there with the housing market and the U.S. economy as in reference to whether or not the housing market was overvalued. But I'm not looking at it through that lens, just to be clear. What I'm pulling this up because I want to look at it through the lens of how important the housing market is to the overall economy. But, I guess you could look at the Buffett indicator that way as well, right? I guess you'd have to look at, it being 200% of GDP or whatever it is right now. And then how many of those retail investors own stocks, what percentage of their net worth it was. But I think it's just kind of a broad proxy. You could come to some conclusions there for sure. But let's go over the GDP, now nominal terms here, guys. And let's start with where we were. Let's go back to 2000. So right at 2000, 2001, GDP was, call it 10 trillion. So now let's check out this chart. And it goes, I don't know why, they don't put the year down here. That's annoying. But we can see it goes from 2000 to 2024, the end of 2024. So back around 2000, it's about 10 trillion. So about the same. It's about 100%. And then when we get to the peak of the real estate bubble, call it in 2006, the real estate market, and this is residential, just to be clear, residential real estate, right around, call it 23 trillion. So now let's look at what GDP was. There you go. So now you see the home prices accelerate way faster than GDP. So just so we're all on the same page, right around here, the housing market was about equal. So I guess you'd say 100%. 100% of GDP, both 10 trillion. Then we fast forward to 2006, and we're right around 13, 14 trillion on the GDP side of the equation. But we are up to 23 trillion, call it. So, wow. You had a massive increase there. You had an increase of, call it 13 trillion in the residential real estate market, the market cap, if you will, the value, the total value. And you only had a, call it 3 or 4 trillion increase in GDP. Okay. So now let's fast forward to where we are today, because I want to compare that with 2000 and 2006 for obvious reasons. And we're right around 30 trillion on GDP, 30. Let's see where we are on the. So in terms of the housing market, we are, yeah, so it looks like we're right at 50 trillion. Okay, so I almost flunked out of high school, as most of you know. So I'm gonna have to do the old calculator. How should we do this? So we do right at 2006, we were at 22 trillion in, okay, so if we were at 22 trillion divided by, let's call it 13. That was, so we're right at 1.6. So then what we would do is now we are at 50 trillion. Well, I can already tell you it's more. So now we're at 50 divided by 30. Oh, well, right around the same. Right around the same. Not that that's comforting, because we're at the same levels as we were at the peak of the biggest real estate bubble that we've ever seen in the United States. So there you go. And I guess my overarching point would be, regardless of how precise that math was, it's all about the concept, right? Think about how important real estate was to the U.S. economy back in 2006, just pre-GFC. And if you want to know the answer, all you have to do is think back to 2009 to 2012 and ask yourself, what was the economy like back then? And for the younger people that might not remember, I remember it well. And it's just all the anecdotal stuff, such as trying to get a reservation for a restaurant. 2009, 2012, you didn't need a reservation. The restaurants were relatively empty. I remember putting an ad on Craigslist in 2012 for construction, just like handymen. Within an hour, I had 100 resumes. You fast forward to 2015, 16, 17, I ran the exact same ad. I can't remember exactly what year it was. Exact same ad, and 3 days, and I'd get 2 resumes. That's the difference. So my point is, it was crystal clear to anybody paying attention how important the housing market was to the U.S. economy just pre-GFC, when everything hit the fan. And the bottom line is we're pretty much at the exact same level now. I would argue, even though this ratio is similar, we might even be more dependent on asset prices, because since 2019 and the government's response to the cerveza sickness, especially with the poor and middle class, we have seen their purchasing power go down. I would argue the purchasing power of the poor and middle class was, even stripping out assets, was better or higher in 2006 than it is today. So I think when you add that variable, I think there's a strong argument how we would be even more dependent. And again, this doesn't even include the stock market. When you include that into the mix, it's like I always say, it's the economy is completely inverted. You just have this inverted pyramid, and the bottom is just asset prices, and everything is kind of teetering on those asset prices. And oddly enough, when you look at the stock market, it's not even the stock market, because the stock market is the Mag 7, and the Mag 7 is NVIDIA. So, I mean, you could argue that the entire U.S. economy revolves around the Mag 7 and housing. So why is this important? Because now I want to encourage all of you guys to check out a podcast episode. Great podcast. And it is, let's go over to YouTube here. Right here from Monetary Matters. Now, this is Jack Farley runs this. He was formerly with Real Vision. A really good interviewer. And very good, very, doesn't really have a bias. He really tries to get to the bottom of what the interviewee is discussing, what their major talking points are. Very good. So I'd strongly suggest it. Although, Jack, if you're listening, just take it from a guy who's pretty good at YouTube, that being me. You got to work on the thumbnails, my friend. The thumbnails are too busy. The thumbnails are way too busy. Clean up the thumbnails, buddy, and you're going to get a lot more views because your content's fantastic. But anyway, he just interviewed a guy named Chris Whalen, who's a banking expert. And you guys can see the title here. A foreclosure wave is coming. Now, he's not an expert on the real estate market, but he is an expert on mortgages, looking at it through the lens of the banking system, mortgage-backed securities and whatnot. And his argument is, now that we've got Trump in office and Dowd and Elon and everything, they're going to be making an effort to get government out of the private sector. Well, what private sector, or what component of the private sector is most heavily subsidized by the government? That'd be housing. It's housing. And you say, George, I don't know. I don't get it. How are you connecting those dots? Because first and foremost, the 30-year fixed rate mortgage. Most countries don't have that. Why? Because it's a money loser. The bank would never do that, because there's just way too much inflation risk over the long run. That's why it's not really a free market loan. It has to be subsidized or guaranteed by the government, i.e. the taxpayer. See? And if you go to other countries, Canada, Australia, etc., you're not going to find a 30-year fixed rate mortgage, because that mortgage is likely going to be on the balance sheet of the bank. And if it is without any guarantee, there's no way the bank's going to do it because there's too much risk and they're most likely going to lose money on it. So that is one of the reasons, just one of the reasons. And then you got the FHA and all these other programs by the government to incentivize home ownership. Ironically, right? Because it just incentivizes homes going up. That's for sure. But the price of homes going up uh, to a large degree eliminates a lot of the buyers, even with these programs that are meant to encourage more, let's say, home affordability. All they do is they jack up prices and make them less affordable over the long run. But again, Chris's point is that the Trump administration, Elon, Doge, are going to do their best to get the government out of the housing market. And if they get the government out of the housing market, the Fed's not buying mortgage-backed securities. Maybe they, who knows? Maybe they eliminate Fannie and Freddie. Maybe they stop guaranteeing the 30-year fixed rate loan. And therefore, all the banks have to do this lending themselves and keep it on the balance sheet. Okay, now what are mortgage rates going to be? And then what is the housing market going to look like if you can no longer get a 30-year fixed rate loan? The answer is a lot different. And so this is why he sees quite a bit of downside risk, he meaning Chris. So again, I'd strongly suggest listening to this this interview. And by the way, it's got 17,000 views, which is very high for the channel, which tells you just how great of an interview this actually was. And obviously, this dovetails perfectly on what we were saying before with this the Gammon housing indicator that's just basically looking at the housing market cap as a percentage or in relationship to GDP to kind of understand the dependency that we have in the U.S. economy towards this asset class. Unfortunately, it's all assets, really. Okay, now let's go. Oh, there we go. Michael Saylor's new strategy for strategy, his new Bitcoin strategy. And I want to be clear. Like, I'm just trying to think this through myself because it's quite interesting. My gut feeling is he's taking on a lot of risk here, and this probably doesn't end well. But I'm open. I'm trying to keep an open mind. Obviously, I like Bitcoin. You guys know that. I think everyone should own it, not because the price is going to $1 trillion or whatever, but more so that it just gives you the utility of Bitcoin. I don't really like it for the price. I like it for the utility, that it gives you that purchasing power outside of the system. In today's day and age, I think that's extremely, extremely valuable. But it has become kind of a financialized asset to a certain degree. Whether that's bad or good, I'll let you be the judge. But I was listening to Snyder's podcast this morning, and I really wasn't even aware of what Michael Saylor was doing or has done over the past week. And what he did is he offered preferred shares where he's paying a 10% dividend yield. 10%. So the first thing that comes to your mind is, my goodness gracious, the 10-year treasury yield is paying 4.3, something like that. So we're at call it 6% premium to the 10-year treasury yield. And if my memory serves me well, just a month or so ago, he was issuing debt at 0%. So why on earth would he want to issue preferred at 10% and have to pay that? And even if he does want to even if there is some sort of, we're going to use this word a lot, strategy to issuing preferred as opposed to issuing the convertible debt that he was, say, a month ago, why is he having to do it at such a high rate? That was kind of a bit of a head scratcher for sure. And then you have to ask the question, and I believe this is, he's using about 500 million to buy more Bitcoin, but he's using a substantial portion of the proceeds from that sale for operating. And that's where, as a former business owner or entrepreneur, I get a little worried, because for me, the risk always goes back to your cash flow. So, which I think is commonsensical, right? Let's say that you take on debt to buy a house, and let's say your monthly mortgage payment is $2,000. But let's say your income per month is $20,000. Okay, well, I wouldn't be too worried about that. But the problem here is, it seems like Strategy has a $2,000 a month mortgage payment, but they have no revenue. And in fact, they have negative revenue when you look at the underlying business. So they have no cash flow to pay this dividend or whatever other expenses they have. And if this is true, then the only way they can do that is by issuing more shares, taking on more debt, or selling Bitcoin, which, again, that's kind of what I'm just trying to think through. And I'm not saying that, they can't issue more debt, or they can't issue more shares or whatever it is, or they can't sell Bitcoin to go ahead and cover this dividend payment. That's not what I'm saying. I'm just trying to ask myself, can they take this out of cash flow? And if not, what is the strategy moving forward to go ahead and make those payments? And what does that mean for the price of Bitcoin? And how sustainable is that long term? So again, comparing this to just a household, if you have a $2,000 a month mortgage payment and you lose your job, so you don't have any income coming in, well, it's not a big deal if you've got a credit card with $100,000 or $100,000 limit. Not a big deal. And it's even less of a deal if you can, let's just say, sell some stuff in your closet for for 10 grand or whatever it is to make those payments. But at a certain point, your credit card's going to run out. And if the price of the stuff in your closet doesn't go up to the degree to which you need it to go up in order to continue to cover those $2,000 a month mortgage payments, you got a problem. Now, that doesn't mean that it's an inevitability, but it just means that it's a risk. And as that homeowner, that's a risk you should definitely be cognizant of. And now I'm looking at the homeowner as a shareholder of Strategy. So let's go over kind of, and I want to be clear, I am by no means a bottom up guy, or I'm by no means a micro guy. I'm a macro guy. And so analyzing balance sheets and all these things, and obviously I used to have P&Ls and balance sheets, but they're all very simple with the businesses that I ran. So I'm just trying to go through this with a fine-tooth comb, using some common sense and coming to some conclusions. And if you guys see me making a mistake in how I'm reading the financial statements, by all means, let me know in the comments. And again, this isn't an attack. It's just more so an observation and trying to think this through out loud, because I think it's really fascinating how he's doing this and the financial engineering that's going on. And then after that, I try to think about the probabilities of how this ends. Okay, so let me do the screen share. I forgot I got to do Josh's job for him here. So what I started with is looking at, I started just using AI, but it was too broad stroke. So right here is from Q2 of 2024, and you've got their gross profit at 80 million, and then you've got the operating expenses at 280. Now, this is a very flawed number, in my opinion. And I think anybody's opinion, I think Saylor's opinion as well, because it includes this what they call an impairment loss on the company's digital assets. So for whatever reason, GAAP accounting makes you realize a paper loss in your operating expenses. I don't get it. Seems like that's how it is. So you've got to kind of take this 280 with a grain of salt, because it's not as though this is actual realized loss. It was just vast majority of it was just, I guess, the price of Bitcoin went down or something like that. But the impairment loss was 180 million. But they had, an operating loss of 280. So you've still got, operating expenses. Those are the actual operating expenses. Let's get down to the actual loss. The actual loss, operating loss, was 200 million. But remember that impairment was 180. So you're still left with a loss of 20 million. And so again, that's where I get a little concerned there. If he was making, with his core business, if he was making, 100 million a quarter or something like that, I really wouldn't be, then what I'd be doing is saying, okay, well, how much does he owe on this dividend, or how much will he be owing in the future? Because it's probably not the last time that he's going to be issuing these preferred shares, especially if he doesn't have any money coming in for his operating expenses, or he's taking a net loss there. So what I'd be doing there is I'd be looking, okay, what's his cash flow? And then, how easy can he service the debt based on the cash flow? Another way to look at that, of course, is to look at the assets on the balance sheet and how easy he can service the debt. But for me, as an entrepreneur, I really wouldn't be comfortable looking at the balance sheet as how I can service the debt. I would be just looking at the P&L. Maybe I'm too conservative. I don't know. You guys can let me know in the comments what you think. So what I wanted to do here is then say, okay, we've got this for Q2 of 2024, but I don't know, maybe this is just kind of an anomaly. So then I went to their new website, which is pretty snazzy here. And because I want to get it from the horse's mouth. And this is their most recent financial statement. This is Q4 2024. And if we go back to Q2 2024, you can see the exact numbers we were referring to there. Is we've got the digital asset impairment loss of 180 million. And then we have the loss from operations at 200. So again, the net there right around 20. But what I found here, if I'm reading this correctly, is this is not a one-off. So if we go to Q3 2024, you see that they had a income loss on operations of 432. That would be 432 million. But the impairment, which is included in that, was 412. So that still gives you a loss of the delta there, the delta between the two. I'm assuming that's what share-based compensation. Not sure that line item. But the bottom line is you're still taking an operating loss even when you include the digital asset impairment. And it's the same for Q4 of 2024, but it's the same going all the way back to Q4 2022. So based on this, I don't see where he's getting the cash flow. Now, again, the argument could be that he doesn't have the cash flow, but that's not a big deal because he can just indefinitely issue more debt or to make the dividend payments or the debt payments. But let's be clear. Let's assume for a moment he is losing $20 million a quarter. Okay, well, he's got to come up with that somehow. Like, if you, if your expenses are $20 million higher than your income, in order to keep the business going, you got to come up with $20 million somehow. So he would not only have to float more debt to cover the dividend payments with the preferred shares, but you would also have to float more debt just to cover your costs, or you'd have to sell more preferred debt to cover your costs at 10%. Uh, How sustainable is that? I don't know. I'm just I'm trying to think that through. Or, of course, you could just sell more Bitcoin, or you could sell Bitcoin, period. My concern there for the Bitcoin price, I wouldn't be concerned with Bitcoin because, again, I look at it as far as the utility, and what Saylor does doesn't impact the utility of Bitcoin whatsoever. A zero impact on it. Zero, zero, zero. So this is just a thought experiment for the price, which, to be honest, at the end of the day, I think is the least interesting thing about Bitcoin. Still a fun thought experiment, though. So the point is, if you don't have the cash flow to make the dividend payment to keep your business running, if it's incinerating $20 million a quarter, then you've got to sell Bitcoin, you've got to sell more debt, got to sell more equity. Now, selling the Bitcoin, he's got a lot of runway there, a lot of runway, because he's got $40 billion of the Bitcoin. But then you've got to ask, okay, he's been buying tons of Bitcoin over the last 2 months and the price has actually gone down. What happens if he becomes an actual seller of Bitcoin? And does that exacerbate the problem there? Does that make it even harder for him to issue debt? Does that make it harder for him to issue preferred shares or whatever it is? Maybe, maybe. I don't know. So now, of course, if the price of Bitcoin just continues to go to a million, he doesn't really have a problem, does he? Or if I was watching another video that I posted on Twitter, which from a bull, which was very, very good, very in depth, very detailed. And they were talking about how this could be a genius strategy, unintended, which it could be, but the assumption there is a few things. The assumption would be that the price of the common shares go up to a certain level to where they would be converted and wouldn't have, even though they're diluted, the price had gone up so much, the shareholders wouldn't really care. And that would alleviate the need to pay the dividend, right? Or it assumed the price of Bitcoin just continues to moon. And it also assumed that the underlying business turned profitable. I don't know. I guess there's some path maybe to profitability that Saylor has been talking about with the underlying business. But it seems like every single time I hear him, he's just Bitcoin, 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 Bitcoin. And I know from running a business, it's very tough to grow the underlying business if it's not really your focus. And then it also made an assumption that if Saylor continues to buy, then it will increase the price. And I don't know. I think we've seen kind of the opposite of that over the last 2 months. So if these assumptions come true, then this absolutely could be a huge windfall for not only Saylor, but for the shareholders. If those assumptions don't come true, obviously the probability is there and the risk is much, much, much different. So the next thing that I want to talk about is what's happening in markets. And today we had a huge up day in the S&P 500, I believe in the NASDAQ, but I want to focus on why the markets went up. So let's go over to CNBC homepage and just do some quick headlines here. So Dow up about 600, S&P up about 1.7600, and NASDAQ up, the big winner of the day. Well, actually, Russell 2000, even a bigger winner as far as percentage terms, up 2.55%. NASDAQ up 2.27. And I think it's interesting that the Russell is up the most. But the claim that CNBC is making is that Trump came out and was a little less hawkish, let's say, on the overall tariffs. And so why this is interesting to me is the market is definitely trading off tariff news. There's no disputing that. Now, we could say that the tariff fear of catastrophe is a little overblown, but again, it's not about what we think. It's not about what you think. It's about what the market thinks. And that's what they're going to use as their motivation or in their analysis to buy or sell. So the market thinks these tariffs are definitely an economic disaster. That's for sure. So then you've got to ask the question, moving forward over the next 6 months, what stance is likely for Trump to take? Are we going to see more of a hawkish tone on tariffs? Are we going to see more of the tariffs actually implemented? Or is he going to start to backpedal? Because if he starts to backpedal, then I think the market is going to go back to focus almost exclusively on the economic data, which I think is still going to be softening. So then we might even get back to a scenario where bad news is good news, and that would be a tailwind for the stock market because that inverse relationship between share prices and the actual underlying economy, as pathetic as that is, and as sad as that is. But really, the focus here is, if he starts to become more hawkish or starts to implement all of these tariffs that he's been talking about, and the market sees that, that likely brings the market down and potentially takes it into bear market territory. Now, it is true that Trump could be taking a little bit lighter tone in terms of the tariffs because he sees the stock market down. And Trump doesn't like to admit it this time around, but remember his first go at the presidency. I mean, it was all about the stock market. Literally, his whole entire presidency revolved around the stock market. And so I don't see how he can completely divorce himself from that view this time around. Although he has come out with rhetoric talking about how, well, we could see a correction. Well, we could see a decline in asset prices, and that might be a good thing. We're flushing out the system, but it's all Biden's fault. How much pain is he willing to take? I think that's an honest question. And it's a question that I think every single investor should be asking themselves right now, because whether or not you think the tariffs are a net positive for the economy over the long run, it's about what the market thinks. And like I said in the first topic, or like we pointed out, the market and asset prices are absolutely crucial, paramount to the health of the economy. So we can't just completely ignore asset prices and say, well, that's the price we have to pay to implement these tariffs because it's going to be so beneficial over the long run. Okay, but again, that what that ignores is how far down we've got to go before we start coming back up, right? Because even if we start coming back up, it's all about how many years it takes you to get back to that high watermark where you were before. So if you have just a slight decline, then you go up, like the cerveza sickness as an example. Very easy to get to all-time highs and surpass them. But if you have something like the GFC, where the S&P 500 goes down by 50%, well, that takes you a long time to get back up to that high water mark. And that's a lot of economic pain. And then you have to ask the question, how does the public start to respond to potential tariffs? if every single time we get them, the stock market goes down, and it kind of exacerbates the underlying problem with the economy. I don't have any answers on this. I don't, if I had to sit here and make a base case as to whether or not I think the rhetoric from Trump and the actual actions he's taking will be more aggressive with tariffs or less aggressive, I'd probably guess probably less. That would be my base case. Because I think he's kind of coming out guns a-blazing and just trying to get a read on what's happening, not just how other countries are responding to this and how much leverage it gives him from a negotiating tactic, but how the marketplace is responding as well. Not just the stock market, but also the bond market, right? Because they've been explicit in saying that they want to get long-term interest rates down. Now, I don't know that I agree with why they want to get those long-term interest rates down, but this is definitely part of their policy. So that to me would be the base case. So that's a tailwind for the stock market. Now, does that override the headwind of likely economic data softening? And that goes back to what we say on this channel all the time. It's all about narrative. It's all about narrative. And when we see the narrative shift is when we see so much data come out that is negative, to where the market has that Biden moment where it goes from Biden is as sharp as a tack to, oh yeah, he's got some real mental issues, because the evidence is so overwhelming that we cannot continue to double and triple down on something that's obviously wrong. And so what is the straw that breaks that camel's back? To me, it's probably the unemployment rate. Probably the unemployment rate. If I were to pick one metric, that in, just look at through the lens of the marketplace, it would be the corporate bond spreads as well. Let's see, I think I've got that here. But anyway, the main thing there, I think, what I'm looking at is the unemployment rate. When you really start to see that spike, I think that's when the market's like, okay, we can't continue to put a bullish spin on this when it's probably pretty obvious as to what's happening. And that's your narrative shift. So assuming that Trump kind of pulls back a little bit, that's a tailwind. The headwind for me would be when we start to see the data soften to the point where the unemployment rate does go up, the market acknowledges that, everybody's off sides, then they start to sell, and then that's what feeds into the economy, which likely gives you that feedback loop. All right, guys, on that note, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video.